You're about to join Niels Kostrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Mark Rzepczynski and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Mark, it is wonderful to be back with you this week. How are you doing over there?
Very good. You know, it's starting to become fall foliage season here in New England, so we get some beautiful colors. We've had a wet late summer, early fall, so we haven't seen as much colors yet. It's maybe a little bit late, but I always look forward to this time of year.
No, absolutely. I'm actually heading kind of in your direction next week, but a little bit further north, and I'll be interested to see how the autumn is playing out over there. Speaking of themes that are playing out, Mark, as usual, I'd love to hear before we dive into all of the nitty-gritty, all the great topics that you brought along that we're going to discuss and debate. Love to hear what's been on your radar since we last spoke.
Well, there's sometimes different phrases stick in my mind, you know, that you see in your reading, and the one that has really captured my attention for the last 2 months and has been rattling around in my brain is the comment that changes are not permanent, change is. So, and I think that we'll talk about like what's going on in the world, but it's something to really think about, that any change is not permanent, but change is. And so that's something that always has now sort of resonated in my brain when I see the news and everyone says, let's get excited about the latest event or the latest cloud that might be hanging over the economy. And I just sort of said, well, we're always going to have change. We're just going to have to learn to deal with it.
Yeah, very true. I mean, you mentioned a few clouds over the government in the U.S. I couldn't help thinking a little bit about, obviously, we're standing in front of a U.S. government shutdown. That seems very likely to happen by now, since I think there was a vote yesterday on Friday that rejected whatever proposal was on the table. I think that's an interesting thing that could have some impact on the markets. I also find it interesting, and I don't follow it that closely, so I don't know if there's any resolution here, but I do find the whole UAW strike, so the United Auto Workers strike, interesting, and what kind of precedents that might be setting when it comes to wage and unionization and all of the things that I think might be maybe causing some challenges for investors in the years to come. And then the third thing, and I don't know if you followed this one, and that is, there is more talk about now, and I saw this was an article in Financial Times, maybe from today or yesterday, talking about restricting leverage for hedge funds. And I'm in particular thinking of how that might impact these wonderful multi-strategy funds that I believe need a lot of leverage to have all these teams of traders sitting around turning unpredictable market returns into a very kind of almost a 45-degree return stream. So anyways, any of this been on your radar?
Well, since we, from our group, we have an allocation from a multi-strat, you know, sort of. So
did I step on some toes here, Mark?
No. I follow the multi-strat area fairly closely, and we've having a lot of discussions, you know, just internally with some of my partners at Theme Analytics. We've been talking about how the market has evolved for different products. And so you used to have individual hedge funds, then you had fund of funds. And what the fund of funds really did is that they said, I could bundle a lot of hedge funds together. But in the process of doing that, they actually, I don't want to say almost over diversified. So Volatility got lower and lower as they diversified, but then they gave a good risk-adjusted return, but the returns, got to a point that they weren't very attractive after you take out fees. And so when you think about then what happened is that, well, the multi-strats came in and they said, well, look, we can build a better mousetrap. We could sort of take the idea of, bundling hedge funds together. But when you find that you get all that diversification, you get lower returns. Well, but if you have a good Sharpe ratio, well, let's just start levering that up. And then what we could do is we could lever it up to a volatility that's consistent with what a lot of clients like. And then you also get a much higher return. So that's made it very attractive. So because it's not the leverage that should bother an investor, it's the volatility. So if, let's say, you have in the case for some of on an unlevered basis, you could have some of these strategies that might have a 3 vol with a 6% return. If you had a 3 vol with a 6% return, that's a 2 Sharpe, approximately. But right now, if interest rates are 5.5%, are you gonna find that really attractive? If let's say that you're only going to get 50 basis points over cash, and if it was a 1.5 Sharpe, then you could sort of say, well, that's going to be like 5%. That's less than what you could get on your cash account. So what they'll do is they'll say, look, we got a 3 vol. Let's use lever it up 4 times. Now we get a 12 vol. But if we start out with that 6, now we're getting 20+% return. So that's what makes it very attractive. And you'll sort of say that a hedge fund structure, a multi-strat structure, could do that more efficiently than an investor. An investor couldn't really sort of say, like, well, I'm going to manage a portfolio of hedge funds, and now I'm going to go to a prime broker. I'm going to have cross margining, and then I'm going to lever that 2, 3, 4 times. It's something that a individual investor or institution can't do easily. So the structure makes perfect sense. Of course, as usual, is that if you have too much leverage, leverage can kill in terms of a strategy. And what you find out is when you get high leverage, well, then you have to be very draconian in how you treat the managers. So if they don't perform, you're going to have to kick them out of the portfolio, which is what a lot of the multi-strats do.
Just while you were speaking, I looked up on the Barclay Hedge website, returns so far for all the various hedge fund strategies. And one thing I do notice is that the multi-strategy index is only up about 2%. And so it's certainly not one of the high flyers this year of all the strategies. Now, what I'm going to say now, I have to be careful because I've only heard it from other people. You may know more about this than I do, but I've heard it from other people this week when I was in London, and I was quite shocked, actually. Also, when I think about all the hoops that we have to go through to get allocations from institutional investors. But I was told this week that some of these multi-strategy funds, and I'm sure that definitely won't be for everyone, basically pass through huge amount of costs, meaning it doesn't show up as a fee for the manager. It just passes through, including significant multi-million-dollar sign-on bonuses to attract the talent. Of course, there were, and I don't know if you would call Citadel a multi-strat, maybe it is, but of course there has been Bloomberg articles and other articles about how they were paying, interns $19,000 a month, flying them business class and whatever. So I have no idea. These are just sort of things I'm putting together as we speak now. But the information about these pass-through costs is something that I would say I can see, or I've heard from other sides that this is happening. And if it is, I'd love to hear whether you think that is true. But if it is, I am surprised that institutional investors who must be making up the bulk of these allocations, including pension funds, et cetera, who have been very hard on pressing fees down for on other strategies, including CTAs, how that can even occur. And even with regulators, I mean, what on earth are you doing if you're just passing through a massive amount of expenses like that? But maybe it's because it's offshore strategy or funds, vehicles. I don't know, Mark. But is that something that rings a bell?
Absolutely. It's an issue that people have been grappling with. And we'll sort of say that when the model works, is that might be a fair way to charge. Because when you think about it, is that if you had a fund of funds, or if you had to look at a bundle of hedge funds, you'd have to pay an incentive fee for every one of them, right? So if you have 5, 10 hedge funds, and all of them have an incentive fee, you're going to have to pay for that. So if you bundle them up in a multi-strat, you're still going to have to sort of pay for some of the those fees. So what they do is they oftentimes will give an incentive fee to the pods, which are the different internal managers. Well, they'll pick up some of the costs so that then they don't have to pay the costs, which usually, if you bought it individually, would be the management fee that you'd have to pay. So some of those costs are passed through. And then if you have to say we're paying an incentive fee to that manager, that internal team, as part of our multi-strat, we're going to also pass through some of those expenses associated with the incentive fees that go to the manager. So when you think about it, let's go back to if you had to do it yourself, you'd have to pay the management fee. And basically, if you have 5 managers and you built a portfolio, you'd have to pay 5 legal, 5 compliance, 5 fees for data, for Bloomberg's, et cetera. So you'd still have to pay all of those fees. If you do a multi-strat, the same thing. They make an allocation to a commingled vehicle for another hedge fund. So you're going to have to pay those fees. So multi-strat, they say, well, we still have all these fees, even though the manager is internal. So we're passing some of those through to the investors. So I think that by itself is not a negative. It's the same cost that you would pay if you had to go out and find those managers yourself. Now, that being said, is that some of the largest multi-strats have been able to do that, and they've been doing it very effectively. And because they've posted very strong returns, then I don't think that a lot of investors have complained about that fee structure. On the other hand, if let's say you have a very poor year where performance may be off, so such as this year, there may be some clients are going to sort of say, I want to take a little closer look at those fee structure, because then the fees could be much higher than what I'm actually, when I look at the amount of fees I pay versus the amount of return I get, it might be out of whack relative to what I expected.
I will say I probably disagree a little bit here, meaning I think there's a huge difference between a manager charging a 1 or 1.5%, because nobody gets 2% anymore, let's face it. But a manager charging 1 or 1.5% to a fund, but then taking all the business risks themselves, and then having to decide how much they can afford in terms of fees for Bloomberg or whatever, legal, whatever, to a strategy where the vehicle can just pass through the cost directly, where there's no real business risk. It's just, are we going to use the investors' money to pay for all of this stuff, whether it's 1% or 2% or 3%? Well, there's no real sort of transparency, I'm sure. I think that's hugely troublesome, frankly. But you could of course argue, say, well, it comes down to the net returns, and if they can continue to do really well, investors should not care. And I have some sympathy for that, but I think there is a limit. And I think once you start passing through fees for signing on bonuses and what have you, I think there's a huge red flag there. But that's just my personal
there's
opinion.
2 parts to this. Is that one, if it's just the fees associated with running some of the business in these pods, because I think the pod manager or the managers within the multi-strat, they're taking a lot of risk, because usually at the extreme cases, many of these multi-strats would be if that they have a hard stop, that if let's say you lose 5% or 7% or some number, they will just tap you on the shoulder and you're done. You're tapped out. You lose all of your money and you're done. There's also talent that you can't normally find, because we'll sort of say that, if an investor wants to say, if I'm buying talent, hedge fund talent, I want them to focus on the strategy. I want them to focus on generating return and not focus on the business. And so the multi-strat structure allows the managers to sort of focus in on the business. They pass around some of the costs. They still get also economies of scale. So if you're buying certain types of data, if you're looking at infrastructure, is that even though you're passing through some of that cost, you're getting some economies of scale when you do it across a large number of pods.
But really, I think they should take the multi-strategy company, whoever they are, whatever they're called, they should say, well, we're going to charge a 1.5%, or 2% fee, and then it's up to us to make sure that we can pay for these pods. And I kind of disagree also on this thing about, well, these people who come into these companies as portfolio managers, that they are taking a massive risk. Well, they know what the risks are. And by the way, they're getting massive upside, because they will get a fairly high cut of the performance, and they will get much more AUM. That I've seen, from people that I know personally, where they go from managing a few $1 million to getting a $300 million allocation, or what it equates to in terms of risk, with massive upside. So as long as they don't lose too much, they can really. So let's not go. I mean, this was a little bit of me taking you down the rabbit hole, which I didn't mean to, but it'll be an interesting thing to continue to follow, because, as I said, there are some forces now out, at least trying to figure out whether there is too much leverage in the system, and that might have an effect not just on multi-strat funds, but on other hedge fund strategies.
Well, this is an ongoing issue. Is that I think that this might be more of an extreme, because you have the pass-through, but whether it's a 2 and 20, 1 and 20, 0 and X in terms of incentive fees, is that ultimately is that the whole business is based on performance. And so, you could sort of say, like, well, if I charge, 1% flat, but if I don't perform, then that fee structure could be expensive no matter what.
Well, Mark, you're preaching to the choir here, because I'm not a big fan of flat fee funds, but that's another discussion we should have, of course.
So, like, the interesting now is that I think that you could get, at some level is that if you want a S&P 500 indexed fund, okay, there are people who charge it for basically 1 or 2 basis points. So in a world where you have ETFs, you have index funds that are charging, we'll say pennies, then I will sort of say I've been there, and I'm sure you've been there, is that if an index fund is up, sort of double digit, and then you come in with any kind of management and incentive fee structure, and you're not performing or beating, that benchmark, even though it may not be an appropriate benchmark, you'll have a lot of people say, why should I pay you anything when I can buy this index fund for nothing? And, there is a lot of dynamics between fees and growth and the ability to sell in the hedge fund business. So I will sort of say that it's dynamic, so that if fees get out of line relative to performance, people will vote with their feet fairly quickly. And any of these multi-strats who don't perform and pass through the fees, they will feel the wrath of investors, if they don't do their job. And that applies to all hedge funds.
Yeah, no, I mean, that's obviously, that's probably the good thing about what we do, is that investors can vote with their feet. Absolutely. Anyways, I'm sure we'll continue this discussion of that topic another time. Now, it is month end. it is quarter end. So I thought maybe we should spend a couple of minutes if you have any thoughts on that. I mean, from my perspective, I would say the month of September was a little bit, I wouldn't call it a massive roller coaster in terms of performance, but certainly for the funds that I tracked the closest, it was a little bit of, strong first half of the month and less strong, slightly negative second half of the month. And that's interesting, but it's also interesting from the fact that once again, we had positive correlation between stocks and bonds, and they both went down. So investors at large, again, did not really enjoy any protection from a classical 60-40 portfolio or whatever relationship they have. So I think those were things that were interesting. And of course, I'm sure many of the people listening to us today, Mark, will know that trend followers continue to enjoy, trends in fixed income markets where once again, they came under quite a lot of pressure in September and made kind of new highs in terms of yield for 10, 15, maybe even 20 years. We haven't seen yield so high. There were also some pretty good opportunities in the grains where wheat in particular was very weak. And so I think it lost, I think it dropped from about a price of 800 a couple of months ago down to about 540. So a reasonable drop in a couple of months. And then, of course, we have the energies. Energies has kind of become this stealth bullish trend that nobody talked about much in June, but trend followers started to get reversals in their signals and went long. And with the exception, of course, of the nat gas cousins, Dutch nat gas and the US nat gas, we've had a very strong rally in energy markets, up 30, 35, 40% in the last few weeks. So kind of those are some of the takeaways. I just noticed here that, the last 3 months, heating oil up 42%. So pretty strong. Then, of course, there were a little bit of a struggle in some sectors, equities for one, of course, with this weaker performance in equity indices around the world. Trend followers, I would say for the most part, probably still long and therefore giving up some open profits. Currencies, probably also a little bit of a challenge, in particular things like Mexican peso that's been trending really well all year, but it certainly had a little bit of a correction this month and so on and so forth. The good news though, Mark, is that my own trend barometer finished the month at 52. That is probably the highest level we've seen, I think maybe all year. So it could be setting up for an interesting Q4, even though I don't want to jinx it, but Q4 could be interesting, as it has been many times in our industry, as I'm sure you remember. So any thoughts from your side in terms of the industry, how it's done in the last month, last quarter?
Well, we started out talking about the fall, and autumn. And I think that all of a sudden now that your evenings are getting cold, a little bit cooler. It's getting colder out there and at night. And, sometimes when you go outside and you sort of say like you have some standing water and you splash yourself with that water that's been standing outside overnight, it's a little bit bracing. And then sort of you get that splash of cold water in your face of reality. And I think that September we'll call it the splash of cold water with reality for a lot of markets. And I think especially from, and you take away from the Fed is that you look at the SEP forecast, the dot plots. And we're saying is that no matter how much we thought that we would sort of say like we're going to sort of see at the end of 2023, 24, we're going to see rates starting to come down and we're going to quote unquote normalize and get back to lower rates. This is that the splash of cold water that's not going to happen. And you say once that happens is that while there's been a decline in bond prices, we'll just sort of say that the long bond, I think, was up 40 basis points, in terms of the yield curve. So we had a bear, we got a bear rally in the back end of the curve. And so we're starting to get a steepening there. And you could sort of say that's just the splash of cold water that we're starting to hit reality. The other reality is that I think earlier in the month, the Russell 2000 year to date was negative. So take out all of the top 10 stocks in the S&P 500. You look at the rest of the stock market. It's not doing very well. And I always look at the S&P 500 versus the equally weighted index, because equally weighted is sort of like that's a good representation of what the overall market is doing. It's a sort of more of a easy breath index. And we'll sort of say that there's a huge divergence between those two. So if you sort of say like the average company return relative to those large cap stocks that have been all concentrated in just a few names, that there's such a divergence between the world of going on there. And then you look at even, divergence between, you've got metals, year to date, they're probably down as a group. Energy is up. You got agriculture is down, but you got precious metals being, sort of flattish. So there's much more divergence going on in markets. And so it's an ongoing theme that we'll talk about it maybe a little bit later here in the podcast. Mm-hmm. Is that the idea of is that divergence? What is the impact of that on trading? And we'll sort of say that there's more spread that we're seeing in markets than we have seen earlier in the year, and that's going to have an impact on the set of opportunities.
Yeah, no, absolutely. And just talking about divergence, just talking about market moves, maybe not all our listeners follow markets as closely as we do. And we don't trade that at Dunn, but orange juice up 97% this year, right? Sugar up 49%, cocoa up 31%, Nasdaq still up 29%. But then to the downside, you have nat gas down 45%, and wheat down 36%. Palladium down 31%. I mean, there are some pretty big moves in some of these commodities year to date. So interesting times, to say the least.
Right. And this is the interesting part when you look at and it's a recurring theme about narrative and quant models or whatever. But it's sort of say like, if you follow the narrative, let's look at wheat as a perfect example. Well, we still have war in the Ukraine with Russia. We know that there have been, on and off. There have been bombing of the grain export ports in the Ukraine. We know that there have been on and off grain deals. And so, if someone said we still have war in the Ukraine, what do you think is going to happen for wheat? So you would come up with a strong narrative for why wheat prices should be the same or at least higher since the war began. And yet here we have a tremendous decline in wheat prices. So you say like, well, the narrative would give you a different one story. But then when you look at the model, if you follow just the trends in prices, you get a very different story or a very different answer to the same question of what should happen to wheat. Investments are driven by narrative, but the narrative is often false. And this is what a quant has to do. And I always sort of give an idea is that I was going to check the weather earlier today. So, and when you look at what's the weather forecast? In some sense, it could be very cut and dry. Here's what the temperature high and low is going to be. Is it going to be sunny or not? What's the probability of rain? Okay. Now, I know in the United States is that they spend an inordinate amount of time on the weather forecast, in the news. And they probably do the same in other parts of the country. This is that they spend a lot of time just giving you a huge narrative about what the weather would do. And all of the answer is it going to be hot or cold? And is it going to be rainy or not? And those are the only things you really are interested in. But they'll spend a lot of time talking about the narrative to just wrap around the forecast.
And transferring that to our little world, Mark. I mean, really, you have all these experts going on financial media talking about why they believe certain things happen. But if you ask a trend follower, well, the market is either going up or it's going down, frankly. And that's all that matters. Yeah, no, good point. I will just run through, I don't have the final performance numbers for September because we still have one day. We're waiting for the numbers to come in on Monday. But as of Thursday night, good month for the CTA world. BTOP 50 up 3.59%. up 3.25% for the year. SocGen CTA index up more than 4% as of Thursday in September, up 2.5% for the year. SocGen trend index up 3.9% for the month and up 1.44% for the year. And the short-term traders index had a good month, up 1.9%, but still down 1.55% for the year. MSCI World did finish the month of September down 4.45%, still up 9.6% for the year. And the world government bonds, tough month, down to more than 2% in September. And the S&P 500 index down almost 5% in September, but still up 11.68% in 2023. All right, Mark, we're kind of halfway through our conversation, and it's time for you to take us through some of your wonderful topics that you have listed and sent to me, and I'll try and keep up and do my best. But the first things you kind of already alluded to, we're going to talk about things. The more that they change, the more they stay the same. So
and that's a good place to start, only because as you come to month end, I'm looking at as soon as you get to the end of the third quarter, then people sort of say, what's going to happen in the fourth quarter? What do you see going on? And so we've talked about, we have the auto workers strike. We've got oil price shocking. So it's clearly that oil prices are in the 90s. We've got the shutdown in the federal government. We still got a debt crisis, and we're sort of seeing is that, delinquencies are up for auto loans. We're sort of seeing real estate is having problems. And then we've got the ongoing issue of just rates going to be higher for longer. And, we had a discussion earlier, because we're run quant models, is that, well, what should we do about this? This is that there are all of these events that are occurring. Is that should we be prepared to lower leverage for the fund, or should we sort of turn some things off? And that's why that initial phrase of changes are not permanent changes, came to hide. So what do you do, or when should you turn off models, or how should you make that decision? Was something that has been bantering around with myself and the partners. And generally, we come to the conclusion is that no matter what we see in the marketplace, the null hypothesis should always be is that don't turn anything off. Is that you should be aware of what's going on. You should hold the course, okay? And then we should, because overrides are costly. So costly in the sense is that first is that you're making a prediction. You're saying the prediction is that market will do X or do something else. And if you're wrong, then that could have an impact on overall performance. And then you have to make a second decision of when do you get back in. So if you cut leverage, or if you turn off a model, or if you turn something off in a strategy, well, then you have to also look at when do you get back in. So we'll always sort of say that, not unless that there's a liquidity event that impairs your ability to actually trade, is that you always sort of hold steady or make sure you hold the models. And, that should be the fundamental view for all the quants is that, and the reason why I could have confidence doing that is that how you do back tests. So you want to try to do back tests as long as possible. Now, I think some managers have very, very long history, so they could look at actual live performance. But you want to sort of say, if you've done a back test, you want to say, I have environments where I don't know if this specific event like this type of strike has occurred, but I know that there have been disruptions, and my model has included that. And I could either sort of look at what those disruptions, what happened during those periods of time, or I could just sort of say, here's what the worst periods have been. And I could sort of say that, and I could still live with that. Well, then I just try to move forward. But I think that this is a constant battle that most people in the quant world have to deal with is, are there situations to turn things off? And we'll sort of say that there should be very limited, or so if you say that a doctor said, first, do no harm. So for a quant, first, do not turn off the model. So what you find out is that when you have a lot of uncertainty, it actually generates slower behavior. And one of the things I was looking at is there's something called a Rogers diffusion curve. And the Rogers diffusion curve, if you look at a bell curve, that there's a speed of adoption for different technology. But you could sort of say the same thing happens with themes in the marketplace or information, that there's a speed of adjustment, and that sometimes this is that adjustments can be very quick, sometimes they could be slow. And what we'll sort of say, if there's more uncertainty than or fluctuations in the market, that throws up, sort of bargains, and it causes people to miss seeing value. And so when we think about the diffusion curve and innovation, well, you get an unemployment number comes out. Well, there might be a reaction right away. So the diffusion of that information and reaction is very fast. But if you say like oil price shocks, well, what's the diffusion rate for an oil price shock? It might take a while before it works out. And so consequently, that's going to lead to, slower adjustment in prices. And that's going to lead to, sometimes better opportunities. Okay. A rate increase, we've gone from 0 to 5.5%, on rates. This is that, you think of there's a diffusion index or a diffusion curve for the idea of higher rates. And in some sense, we'll sort of say it's taking a little bit longer, but that still means that you're going to be more opportunities going forward as the market starts to react to the fact that, well, rates are going to be higher for longer, and now this is impacting my ability to lever. It impacts my ability to borrow, and it impacts my ability to, in some cases, if I have a variable rate loan, to pay back the loan. So in some sense, let's go back to, and I always sort of say, let's go back to first principles for trend following or other models. This is that we've talked on the podcast before. This is that I'd like to say that myself, Andrew Bruner and Pete Wild as our theme team, is that we focus on change point detection. Okay, we're looking for change points in markets, and change points can come in two forms. They can either be, an opportunity for reversal, but if there's no change, then you're probably going to be trend. And we'll sort of say that because a lot of the storm clouds we've seen have actually sort of have a longer term effect, we may be in the fourth quarter going forward more in a divergent world. We're going to be in a period where there could be more opportunities for more dispersion in returns and more dispersions in behavior. So I think that's going to be the positive sign for the fourth quarter if you're a trend follower or if you're someone who's looking for divergence in marketplaces. And we can already see that in let's say, sector returns. You sort of say like, the overall market is looking a little flat, but at the same time is that communication services and as an equity sector is up like 40%. Okay, you've got real estate and utilities, down. Real estate is down 5 plus, utilities, over 14%. So there's actually a big divergence between different sectors in the marketplace. And the issue is that always can't happen forever. So what you're going to see is that there's going to be opportunities as markets sort of like move from high divergence to smaller divergence. And in some cases for other markets, they're going to go from low divergence to higher divergence or higher dispersion. And so when we talked about the return pattern that we've seen, you have energy, it has some great opportunities. That's a great opportunity for trend following, but we also know that that's going to have an impact on other sectors that have, and that could be in an opposite direction. The cost of energy goes up. Well, the cost of mining goes up. The cost of agriculture, farming goes up. It may not have an impact in the near term, but eventually that's going to have a stronger impact on the overall, pricing across markets. So we're seeing that this is a good opportunity, but at the same time, we'll sort of say that while we look at these short-term storm clouds, and that would be, for example, a strike or a government shutdown, we're still haven't really internalized all of the worst cloud, which is the rate increase. This is that in some sense is that there's still speculative excesses in the marketplace. And from a trend perspective and from a bigger macro perspective of where are the opportunities, this is that we still have a bubble economy. And we're still going to, and we're going to see that this is as credit becomes more expensive, then we're going to see that that's going to have an impact on any market's ability to maintain a bubble. So look at this as that housing. Housing is starting to finally turn over around the world. So housing prices now the issue is that we would have a worse housing crisis, especially in the United States, if it wasn't for the fact that many people have such low mortgage rates because they locked them in at the lows that they can't afford to move or can't afford to sell their home and go somewhere else. But if you look at new homes, the prices are coming down. So there's adjustment of the housing bubble. We'll say, the goods bubble from the pandemic, has led to inflation. We're seeing that come down. We're looking at the rates bubble that occurred. Now we're sort of saying this is that we're getting to a new permanent high in interest rates, and in particular is that you more in Europe relative to the United States, Niels, can you remember that there used to be negative interest rates in Europe and other parts of the world?
What's funny about that particular part is, of course, that I think the last let's call it 15 years or so, in many ways have been very illustrative in the quote-unquote strength of trend following, the strength of not predicting anything, because as I'm sure others will remember, there were certainly a long period of time where, and I use this as a general term, but I think investors started to believe that clearly rates couldn't go below a certain level, whether that was 2% or 1%, whatever. But as you rightly said, it turned out that actually they could go negative. And I think that kind of, rules-based disciplined approach where you just don't make any prediction actually was a very good example of the benefit of that, even though CTAs were most likely criticized for, well, they're just making all their money in fixed income. And we did. But we did it because we had to. That was the rule. And now you can say, well, actually, we've seen the complete reversal here, where lots of people and experts in particular refuse to think that interest rates could go as high as they did at the speed they did. But once again, trend followers probably for the most part have been short fixed income markets for the better part of 2 years now, even if we've had a few wobbles along the way and a big one in March. So to me, I think there's so many good examples of the benefit of having a diversification of investment process, not just diversification across markets. And maybe that's what we will see more and more investors realize as time goes by, and as they seem to realize now, the fixed income markets, that bond yields might actually continue to go higher. And I haven't said this for a while, but I still believe that we've lost our imagination of what can happen. So we need to start imagining the unimaginable. And I think we've seen quite a few things already in that, like negative interest rates, negative oil prices, short-term interest rates going up by 5% in 15 months, and so on and so forth. That, I think, to many people is the unimaginable. But I worry that this is just the beginning. And I think, and I didn't read the article, but I saw some headlines where Jamie Dimon was out saying, well, is the world ready for 7% Fed funds? And I don't think it is. I don't think he believes it is. But what if it's not 7? What if it's 10? I mean, the thing is, it's almost like we know how this will play out. But the truth is, we don't know how this will play out. So, and so much so many surprises in the coming period, whether it's the next 5 or 10 years, but I don't think it's going to be more calm, unfortunately.
When we talk about negative interest rates, I'll admit to all of your audience that was my one of my days of infamy. I was with John Henry, and we were talking about whether, what we should do. Interest rates were going low at the time when I was working with him. And I said, well, rates can never go negative. I said, yeah, there was some structural issues that it went negative for a few days, but I said, it's not going to happen. And it was one of those, he was saying, it's well, yeah, it could happen. It's possible. And it was one of those things, that's always stuck in my head. We're having this argument about whether rates could go negative, and then, darn it, it goes negative big time, in many markets. And I sort of said, yeah, he was right. And I probably didn't have the right emotion. And that gets back to, what do you do about markets and overwriting? What do you do is that there are worlds we can't imagine for different assets that could occur, that as trend followers you have to be prepared for. Okay, and that's the same as is that also on reversals. Is that if you're looking for any kind of change, is that there are changes that will occur that we're not prepared for, that you have to allow the imagination to take hold for, and so I think that the rate environment is a perfect one. Is that there's the term premium, which would be with the New York Fed, has a nice website that shows what the term premium across the yield curve is, which would be what's the excess return that you should have for holding duration. It was negative for a very long time. And so, you never sort of say I'm going to have a negative term premium for taking on duration risk. It happened. Is that now it's kind of go positive. So you can never say never. So you always have to be prepared for those. And so you have to, if you can't have the imagination, then you have to at least allow your models to be able to have the possibility for some things that you have not explored in your own mind.
All right, Mark, where do you want to go next? I'm not sure we're going to get to all of the topics that you listed, but maybe a few more. Well, where do you want to go focus?
Let me talk about two things that sort of catch my eye, and always in terms of research, that are a little bit of things that are that I found interesting. And then let me just talk about some of the research that I'm working on currently, because I think that I could always come back with that later on as I get more results, but then at least sort of give maybe listeners a chance to sort of say okay, here's what, there's sometimes the view is that we have our models and we keep them in place and we don't change. And I think that a lot of, quants are very dynamic. They're always looking at a feedback loop. They're always trying to sort of say, can you improve? Others don't. But I would sort of say that, at least my approach is to say that I always got to be learning. I got to be thinking about how can I improve a model, or what can I do next for the next model? So let's start with, first the two things that I found sort of interesting. And these are just little psychological studies, because I think psychology has such an impact on markets. And part of a model is to take out the emotions, or actually, quantify the emotions. And so one is that there's a study that looked at counter-cyclical risk aversion. And they said that if you prime, professionals, so they did a survey of professionals, financial professionals, that you're in a boom period with positive stories, and then you show them, let's say, a graph of what could be the potential return for an asset, that they'll actually take on more risk. So if they think that they're in a boom period, they'll take on more risk. And lo and behold, is that if you prime them with pessimistic news, or the idea that we might have a recession, they actually cut their risk. Okay, so the risk aversion is very counter-cyclical, but based on what the priming of what the news they read or how they look at it, that will have an impact on the sizing of positions that you take, which I found is really interesting. Now, modelers in our model, we don't sort of say prime on the news. So we don't have this counter-cyclical risk aversion because we just say, here's the kind of size you'll take if this is the opportunity or the count or the signal size. So you get more extremes. So if, let's say, we're in a period when now we're going to hit more news that is negative, then we're going to see that there's going to be, risk size are going to be taken down in positions. And so that's going to have a certain overall impact on behavior. The second is that study I found that was really interesting, and some of these haven't been done recently. It's just that I uncovered them. Is that there's a big difference between whether a trader believes or sort of sees that there are realized returns or unrealized returns. If let's say that you have an unrealized loss, that you don't react as strongly as if the loss is realized. If the loss is realized, you're going to actually cut back your risk. You're going to sort of become more conservative if it's realized. If it's mark to market, it's unrealized, you don't react as strong. Now, from an economist's point of view, you'd say it doesn't matter whether it's realized or unrealized, and especially in a futures market, you mark to market every day. So you should be, whether you happen to realize the loss or not, there's a loss if, let's say, it's get marked every day. So my reaction should be the same. And the research tells us that people sort of react differently versus realized and unrealized loss. So again, the emotions that people have in their trading wouldn't be displayed in the model, which again is that I always sort of say that's the reason why you want to try to go with models. So, now, I'm not going to.
It almost touches on. I don't know if you were just about to say it, but obviously we do have some very close friends that has this very different way of managing risk, where they look at open and closed profit separately. But of course, open profit could also be an open loss. It doesn't have to be a profit. But I wasn't sure whether you dared go down that rabbit hole.
Well, this is actually a good topic for further exploration for other people to sort of say, like, I wasn't going down that path, but that actually is matters. Is that okay? Yes, this is that. Do you play with the house money or not? In terms of it's like, okay, if I've got open trade profits, should I use that to lever up more? Or do I sort of say, no, I'm not going to play with the house money. So, but that's an ongoing issue of how you build models. So there's the psychology, and then there's the model building issue, which I think adds another complexity, and also sometimes I use the word it adds complexity to models, is also adds personality to models. So I think that the audience may not always realize that every model is not dispassionate. Every model has a personality. There is a personality associated with the model builder that's embedded in what they do. Now, you could say it's very rules-based. Or you could sort of say that it's unemotional, but a model has personality. So what am I working on? And I guess, and that's might be a good place to sort of end, is just some of the topics. So the one thing my partners, we spent a lot of time, we're looking at dispersion and correlation, because we trade a lot of markets. We'll trade the individual stocks in the S&P, the Russell 2000, and so we spent a lot of time what is the opportunity set? And if there's more dispersion in markets, then that should lead to more opportunities, right? And this applies even if you look in the commodities markets, is that there are periods of more dispersion should give you greater, return opportunities. And then when there's less dispersion, or dispersion is very low, then it doesn't matter whether you have a trend following model or whatever type of model. If there's low dispersion, then the opportunity set is going to be smaller. You're not going to get as much return, potential.
But can I challenge that a little bit? Maybe, and I could be completely wrong here, Mark, but we are right in saying this thing about, well, in one way we want markets not just to move. Ideally we want them to be divergent. And that's a good environment for trend followers, for example. But you could equally say that and I think maybe you could say that that's a good environment for trend followers where there are opportunities but where the portfolio doesn't get too risky, so to speak. Because I think we make a lot of our money, frankly, when there is concentration. So there are a couple of themes that drives, and you could say the correlation risk might be high because suddenly things can change. But as long as that train is running, that's where we're going to make a lot of money. Like last year, where there were just a couple of themes and so on and so forth. So I think it's always a balance of how do we manage more dispersed periods of time and how do we manage periods where the portfolio has more conviction. And I don't know that it's the dispersed periods that are the most profitable, but they may be more low risk and profitable.
So, well, you hit on the problem itself because
okay.
So in fact, this is I could make these, especially on a podcast, you can make a broad generalization. This is that, like, well, we want more dispersion. But then you say, like, the devil is always in the details. And the detail, for example, in terms of why this is an important research issue is that I always say the dirty secret for trend following is that, yes, we like to have diversified markets, but we make our most money when correlations are high, when a lot of markets start moving all of the same direction or they're reacting to the same common theme. So when you have high correlation across markets, then that usually means that there's a common factor that's driving them. And so that's one environment. So there you have less diversification, you have higher correlation, but then you have a common factor. And so you're trying to exploit that. Other times you're saying is that, well, I want diversification because I want to have one market going in one direction, another going in a different direction, and they're not correlated. That's great. But sometimes that doesn't work because you could have, like, I'm making money in one market, I'm losing money in another, and it sort of cancels things out. And then there's also the transition is that if I've had high correlation or, I have high dispersion, that usually doesn't last. And when the dispersion across markets starts to collapse or starts to decline, well, then that's, a period for, we'll call it mean reversion or reversals. So that's a different type of market. So when I have low dispersion, then below normal, I expect it to, explode out. Well, then that's a more divergent environment. When I have high dispersion, I expect that should collapse to the mean. That's going to be more mean reverting. So correlations could be high across markets. Well, that could be a great environment because if I get it right, I'm going to make a lot of money. But if correlations are low, it could be a different environment.
So how do you deal with that, Mark?
Well, you're just going to have to invite me back again to give you some answers. So, and that's why, when we've talked about, I spend time on this change point detection because we say, like, how can we sort of look at different environments and look at what's the likelihood of different types of changes. So that's what we're trying to sort of, I think we solve some of it.
Okay, so just maybe for my understanding here, so are you suggesting that one of the things you guys are trying to do is to kind of determine which periods you want to be a trend follower and which periods you want to be kind of a mean reversion, sort of a contrarian type trader?
And that's what we've we like to sort of say that there are change points. Those change points could be like a trend environment, or let's say if there's no change, then we could sort of say then mark as trend because there's no change, so a market in motion will stay in motion. And then there are other periods where markets might get overextended, so they're at an extreme, and those will be periods of reversal. So can you figure out, and as sort of the core problem of always we're trying to work at, and we do it, I think we're doing it a good job. You always want to do a better job. Is that can you sort of say, can you identify those periods when maybe markets are more at an extreme and so there's more of a likelihood that there's a reversal? It doesn't mean that it's going to happen with certainty, but you want to sort of say, I always sort of say, like, don't tell me the narrative, tell me the count. So if certain conditions happen, what's the probability or likelihood that there could be a reversal? What's the likelihood that it's going to continue to trend? And so that's what we're trying to that's the overall issue that we're trying to sort of face and get to. So is that for a trend follower, every time you're looking for it, is you're trying to say, it's like for a man with a hammer, he's always looking for nails. If you're a trend follower, you're always looking for trends. If you're a mean reverting guy, you're always looking for mean reversion. So in some sense, those are special cases of the more general case of what is a change point. So either a change point exists or it doesn't exist. So, how do we actually measure those periods of whether there's change or no change?
Yeah, we'll definitely have to continue that another time. That's a big topic because I think that's one of the things that as an industry we've always struggled with. And we keep saying to people, well, you need to have a correlation to trend following because you never know when the trends occur. So trying to predict when to be a trend follower and not to be a trend follower is an interesting topic. I'd love to explore that. I've not seen many people be successful at it, but doesn't mean that you can't be. So we need to dig a little bit deeper here, Mark, to find out how we can do these things. So we'll do that next time you're on.
So and with that, we're tie that into, we'll call it the regime environment. So when we spent earlier we sort of said there are a lot of clouds. And so then you might be saying something about, in a narrative sense, I'm suggesting that there's going to be a change in regime. And when you think about it, even for all types of hedge fund strategies, most people will look at this as an unconditional forecast. So I just look at an entire back test. I sort of see what works, what doesn't work. And then I sort of say, then I'll just apply it to all cases. I'm oversimplifying. But in some sense, the holy grail is to say, what happens if I condition on the environment? Is there things that I could sort of say about what kind of regime I am in? And if I'm in a different regime, do I sort of skew more of my risk to certain types of markets? Do I skew some of my risk to the long side versus the short side? So now, in some sense, we talked about a lack of imagination. For this, from a quant perspective, it's not made out a lack of imagination, maybe a lack of data to sort of say I have to have enough regimes, environments, the count, so I could be able to say that here's actually has a meaningful probability of it occurring.
And that's actually quite an interesting point you make because I think a lot of strategies that have come, we mentioned multi-strat, right? Multi-strat is incredibly popular with many institutional investors, but let's be frank, that strategy has never traded in a high interest rate environment before. All the data is from the last 20 years where interest rates were low. And there's probably a few other strategies like that. So this is interesting, and I think trend following has certainly an advantage in the fact that there are managers out there, of course I work for one of them, that have traded through many different environments because their track records are so long. And that's very unique. And I think it's underappreciated by folks because they just look at the fact that, when you have a long track, your Sharpe might not be as good as if you only had a 5-year track and so on and so forth. Yeah, true. But the fact that you're in business after 50 years, that should mean something, so to speak. Anyways, lots of good stuff to talk about, Mike.
I was going to say that a lot of the newer strategies and the new techniques is, C.S. Lewis often talked about chronological snobbery, and that the new should always be throw out the old, and so in some sense, if you're a seasoned veteran, well, then we're going to put you on the bench because our chronological snobbery says that the new strategy, the new technique is the way to go relative to all others. So, but this,
I think we're being conditioned of that every quarter or every year when all these new gadgets come out. iPhone 15 should be better than iPhone 14. You would think, right? But it doesn't necessarily mean that a 1-year-old strategy is better than a 50-year-old strategy, as you rightly point out.
As I get older, I'm more acutely aware of chronological snobbery.
Fair enough.
So with that, probably that might be a good place to stop.
Yes, no, absolutely, and actually, it's I want to make just one important announcement, because I did mention it last week when Alison was on. Because I will be getting a little bit of a break from the weekly conversations on the Systematic series, because I'm going traveling. So Alan has very kindly said that he will be happy to host the next 3 weeks while I'm on the road. So I'm sure Alan and our usual amazing co-host will be tackling some really interesting topics. Maybe they have completely different opinions about these topics that we have been discussing, Mark. We'll find out in the next few weeks. And obviously, I hope everyone will tune in as usual and give us your feedback, your comments, rating and reviews, as you are so kind to do every single week. So, from Mark and me, thanks ever so much for listening. We look forward to being back with you next week, although it will be Alan at the helm. And until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.